Welcome to Retiring Well, where it's our job to help you enjoy financial security in any economy. We have got a terrific show lined up for you this week. For you James Bond fans out there, we are going to ask the question, is the sky falling on bonds? I know a little fun play on words there, but it's an important topic and one that you need to know about. Now, before we go any further, let's meet the real stars of the show and the advisor who are in the trenches, visiting with people just like you.
And in Birmingham, this is Tad Hill, your chartered retirement planning counselor and retirement planning specialist.
Retiring Well with Michael Reese, providing financial security in any economy. Today is the day you can take control of your financial future and eliminate worrying about your money forever. Featuring chartered retirement planning counselor Tad Hill, founder of Freedom Financial Group in Birmingham.
This week's topic is the sky falling on bonds. I know it's a fun little play on word on a recent Bond movie for you James Bond fans out there. Anyway, for the last couple of years, a lot of the experts out there have been predicting that the sky is falling. They've been like Chicken Little running around. The sky is falling on bond prices, and bond prices are about to plummet. They're about to just crash. And we've been hearing that now for a couple of years. Why has that been going on? Well, first of all, what you need to understand is that bond prices and interest rates are inversely related. What that means is, as interest rates have been falling, bond prices have been rising. But the opposite is true as well. When interest rates rise, bond values fall. So what all the experts have been saying is they're saying, look at this. Interest rates for the last couple of years have been at historic lows. And at some point they've got to go up, they've got to rise. When they do, bond values are sure to crash. Well, recently we've got this article from CNBC.com, and it's titled 5 Bond Questions to Ask Your Financial Advisor Now. And it's all about this issue of, are we at the point where interest rates are about to rise, perhaps dramatically, and thus create a real challenge in the bond markets? So I just want to go ahead and read some of the questions here. I may not hit all of them, but there are a couple in here that are pretty important in my opinion. Here's the first one, and it's a great question. Should I shorten up on bond duration or just sell them all? Now, bond duration simply means how long of a maturity or how long of a period you have before your bond matures. So if you have a 10-year treasury bond, then you've got 10 years before it matures. If you have a 2-year treasury bond, then you only have 2 years. The shorter the time to maturity, the less of a factor interest rates have. So the question is, if we think interest rates are rising, that's going to hurt bond values, should we shorten the maturities of our bond holdings? The answer is, if you're going to hold bonds, definitely yes. Now, the other part of this question is, should you just sell everything? Should you hold bonds at all? That is a different question. That really depends on your circumstances. It's impossible for me to answer that on a television show. But it is certainly something you should be asking yourself in this kind of environment. Why hold any asset that you know has a good opportunity or a good potential, if you will, for falling in value? And right now, bonds certainly have a greater potential to fall in value than they do to rise. Another question here, what about emerging markets? Are they potentially the answer, emerging market bonds? Well, here's something that perhaps you are unaware of. If you look at the iShares, it's an exchange traded fund, the iShares MSCI Emerging Markets Index Fund, so the Emerging Markets Bond Fund, it routinely swings 25% in value every 6 months. That's a lot of volatility, a lot of ups and downs. So is it a good idea to add in something in your portfolio that could go up or down 25% in 6 months? I don't know. Usually we look for bonds for more safety, for more stable position in the portfolio. And then another question, the last one I really have time for, is should I go active or passive with my bond management? You know, that really depends on your circumstances. You could get an index fund and just ride it out. You could hire managers like PIMCO Total Return to see if they could beat the market. That really is a personal preference. But what I want to do now is I want to go ahead and turn this issue, this topic, over to your financial advisor, the ones in your market that talk to people just like you, and I want to get their input on this topic.
And now, featuring Chartered Retirement Planning Counselor Tad Hill.
Well, it's critical that we are aware of the relationship between interest rates and bonds. So, Mike, I think today's topic is right on the money in terms of what people need to be paying attention to. The 10-year Treasury hit an all-time low last July at 1.32. I may have 1/100 of a point off somewhere, but it's real close to that. 1.32, and since that time, it's been slowly ticking back up. All of a sudden, Bernanke comes out and he says, well, we might consider if the economy does what we think it's going to, there's some talk about us at least giving thought to maybe starting to reduce the bond buying. So he didn't even say they were going to do anything. All he said was that they might think about doing something, and boom, what's happened to the stock market? What's happened to interest rates? So the stock market's been dropping. Interest rates have gone up almost a full percentage point in the last 45 days. So this is exactly the kind of overreaction that people have been afraid of as soon as the Fed started talking about reversing their policy. So we're seeing it happen. Now, this doesn't mean that it's going to continue. I can't predict the future. I wish I could, but I can't. But what I do know is this. If interest rates are at historical lows and they're starting to come back up, then we need to be prepared for the fact that that may continue. And the biggest part of our portfolio that we have to be concerned about are our bond holdings, because like you said, Mike, bond prices are inversely related to the direction of interest rates. So if interest rates are going up, bond prices are falling. And I think later in the show, I think on the Chalk Talk today, you're going to talk about how that relationship works. So that'll be a good education for folks. So what do we do? So right now, what we're doing, guys, is in our conservative income portfolio, we are focusing on bond holdings that have very short maturities or very high quality, or possibly even a little bit in the high yield space where it's lower quality, but we don't expect the spreads to narrow as fast as they will in the other areas. In addition to that, we want to get some exposure to things like floating rates and senior loans and tips and those sorts of things that are going to go up with interest rates. Now, we may, as a bond alternative, we might look at something like our Mink portfolio that's only yielding about 2%, but it's very stable and it's better than, the rate we're going to get on CDs these days. If we're going to use the money for income, one of the things that we'll often do is set aside some of our dollars to create a pension. So we know as long as we live, we've got money coming in the door. So there are certain types of annuities that have an income rider on them that will grow at a fixed percentage, like 5, 6, 7%, as long as we're in deferral. And so we can get that fixed growth so we know at a certain point in the future exactly how much income we can generate. Because after all, isn't that really what bonds are designed to do when we hold them? Typically, we're holding bonds so that we can generate income from them. That's one of the main reasons to have bonds. So these are all different ways to generate income without overexposing ourselves to interest rate risk. And this is all part of our retirement planning roadmap. If you want to understand, hey, how do I insulate myself from these risks that are coming? The world's very confusing these days. The stock market's falling, interest rates are rising. How do I protect my retirement? Give the number on the screen a call, and I'll do our retirement roadmap review for you for absolutely free at no cost. This is where we sit down and we analyze your details so we have a good idea of how to construct a plan to give you the best chance of having the retirement life that you want.
Folks, there's some terrific information on what's happening with bonds and some alternatives that you could consider provided by a retirement planning specialist, someone who works with people just like you each and every day. You know, if you have questions about this, if you want to just talk to someone about your alternatives, you know, feel free, pick up the phone, call the number on the screen. Just talking to one of these guys makes a lot of sense. All right, don't go away. We're going to have our question of the week.
Let's talk about a customized retirement plan. Retiring today is not what it used to be. What works for your neighbor may not be best for you. Yet everywhere you turn, it seems like financial firms are giving cookie-cutter advice.
Your circumstances are different than anyone else's. As a chartered retirement planning counselor, my Retirement Roadmap Review is designed to uncover the must-know facts for your situation before we start implementing solutions.
It's one more reason that now, more than ever, you need to talk to a retirement planning specialist. Why not call the number on your screen right now? We'd love to talk to you about protecting your retirement. You've worked your entire life to become financially secure so you can enjoy a comfortable retirement. But when you get there, what's next? Wall Street and the financial media flood the airwaves with information about what you should and shouldn't do. But who are they working for? Who can you trust?
For the past 17 years, I've focused on helping people just like you protect and preserve their retirement security. And during that time, I've identified 7 different lies, each with the potential to destroy the security that you've worked so hard to build. I believe that you deserve to know the truth. And so I've built a website that hosts a series of videos that's free of charge that you can watch in the comfort and safety of your own home.
You don't want to miss out on these powerful videos that shine the light of truth on what can be a confusing topic. Why don't you go there now? It's absolutely free, and you'll be glad you did. www.retirementincomelines.com. You deserve to know the truth.
Welcome back. It's time for our question of the week.
This week's question comes from Brent from Windsor Heights, Iowa, who writes, I have 8 different mutual funds. My advisor tells me that I'm well diversified, but another advisor said that many of my funds hold the same thing. How can I tell if I am diversified or not?
Oh boy, Brent, you may or may not have heard me say this on the show before, but I'm not a believer that investments are either good or bad. In most cases, I think investments are like medicines. They're designed to do different things. So are stocks good or bad? Are bonds good or bad? Are annuities good or bad? CDs good or bad? Cash good or bad? Well, it depends. What are we trying to accomplish? So what a mutual fund often is designed to accomplish is to give us diversification. So if we've got a little bit of money, we don't have enough money to really construct a fully diversified portfolio, but we need diversification. We don't want to just go put our money in a single stock. A mutual fund or a single bond, a mutual fund gives us that diversification. The drawbacks of mutual funds, in my opinion, are that typically they're very expensive, and unless you are really clear on what's inside of them, if you've got 8 different mutual funds, there is a good chance that you are overly concentrated in the same type of holding spread across the different funds. Or the other risk is that you're what's called over-diversified. There's a point at which you reach diminishing returns, that if you've got so many different holdings in your portfolio, you are robbing yourself of the opportunity of growth. So we actively manage our portfolios. We construct a portfolio of stocks, bonds, ETFs, that sort of thing. We don't normally use mutual funds for the reason that we can typically accomplish the diversification of a mutual fund at a lot lower cost. Most mutual funds are pretty expensive when you really understand what's going on under the hood, all the trading costs and that sort of thing. So I'm not a big fan of a mutual fund portfolio. I think that we can accomplish it in a different way. The way you find that out for yourself is we have an institutional Morningstar system, our reporting system, that will take your holdings and tell you whether you're over diversified or you've got too much of a concentration in one holding, or how much your expenses are. Do you even know what you're paying inside your mutual funds? If you want to know the answer to that, give us a call. Come in and we'll run this report for you. At least that way you're aware of what you're paying. So you're paying the mutual fund, and you're paying your broker, and you're paying some custodian fees. A lot of times your expenses are a lot higher than you realize. So if you've got these questions for yourself, you want to have this report run, give us a call. We'll sit down and do it for you.
Do you want your question answered on Retiring Well? Send us an email to question@retiringwell.tv.
All right, this week in Chalk Talk, I want to share with you the core relationship between interest rates and bond values, and what this idea of duration is that we talked about a little bit earlier in the show, and maturity, and how it affects the swings in bond values. So here we go. This is our classic playground teeter-totter. And what I mentioned earlier in the show, I've illustrated here. We have interest rates and bond values. They are at opposite ends of the teeter-totter. And what do we know? We know that interest rates are at historically low levels. And what does that mean? That means that bond values are what we would call fully valued. They're at high levels because opposite ends of the teeter-totter, of course. And what everybody's worried about is the following. They're worried that interest rates, which have been very, very low, they're worried that interest rates are going to go up like that. And if interest rates go up, how is that going to affect bond values? Well, clearly, it's going to knock them down to Earth in, like a comet, asteroid coming to Earth. It's just going to crash. Now, duration, or how long to maturity, plays a big role here. And maturity and duration are not the same thing. They are related. And here's what I mean. The longer term bonds, like the longer term bond you have, if you've got 30 years, for example, to that bond, till it matures, that means your duration's longer, and that exaggerates the impact of interest rate movements. So the more, as interest rates go up, you have an exaggeration. The values are going to go down even more. So what you want to do is, if you think interest rates are going to go up and you're holding bonds, you don't want this 30 years. You want to shorten duration all the way down to 1 or 2 years if you can. Held really short-term bonds, because they are not nearly as affected by those interest rate swings. So that's really important to know. So remember, opposite ends of a teeter-totter, and the longer your duration, or the longer your maturity, the farther out you are in that teeter-totter, and the more exaggerated the impact of these interest rate movements. Now, as long as the Fed, the Fed is printing money, they're trying to keep these interest rates down. They're trying to have them increase at a measured pace. We'll see how well that actually works in practice. For you bondholders, you need to know about this relationship.
Let's talk about retirement income. Studies show that a large number of retirees are worried about running out of money. Broken promises from banks, Wall Street, and the folks in Washington, D.C. may have you worried about your own retirement security.
Having a predictable income stream is a key ingredient to protecting your retirement. One potential way to do that is to have your income stream based on math and not markets.
It's one more reason that now, more than ever, you need to talk to a retirement planning specialist. Why not call the number on your screen right now? We'd love to talk to you about protecting your retirement.
Hi, Michael Reese here, and what I found is, in that critical period, the 5 years before retirement, all the way to the 5 years after retirement, in that 10-year period, I find that over and over again, Americans are making mistakes with their financial planning that quite frankly, are easily avoided. And it really almost breaks my heart, because if you make little mistakes in this period of time, you can have huge consequences. So in order to help you not make those mistakes, I've put together a simple website with some free videos from me to you to help you be smart about your planning. The website is called 3mistakes.com. It's the number 3 spelled out, T-H-R-E-E, 3mistakes.com. Why don't you go there today?
Okay, Birmingham, retirement story of the week time. This week we're going to be talking about Joe and Carol. Joe and Carol are from Vestavia, and they came in about 6 months ago with a $1 million portfolio of mutual funds. And they had been hearing about how the market had been doing so well, but they weren't experiencing that, and they weren't sure why. So we ran the report that I talked about earlier on today's show. We ran our portfolio analysis software that took all of their holdings, showed them whether they had over-diversification or too much concentration, showed them what the expense ratios were inside their fund, and how much the downside risk was if we went through another 2008 or 2001, 2002, 1987, early 70s, take your pick, big market crash scenarios, how much downside they had. And here's what they found. They had told their broker that they needed income from their portfolio. And because the markets had been going up, they had been making enough money to generate that income. But what they didn't realize was most of their gains were because of the increase in the market values. One of the things we look at when we're analyzing a mutual fund portfolio, particularly for retirees, folks that are needing income, how much yield are we generating? And when I say yield, I don't mean how much did we go up last year. I mean, how much income are we throwing off? Cash flow. That comes in the form of interest and dividends. So we ran this report, and what do you think we found? Joe and Carol's $1 million portfolio of mutual funds had a 1.75% internal cost ratio on average inside their mutual funds. They were paying their broker 1% on top of that. They had a 40% downside risk in their portfolio. So in other words, if we were to go through another 01 or 02 or 08, 2 periods of time where the market was down 50%, they were going to be down between 35 and 40% based upon the type of holdings that they had. They were very surprised by this. When I asked them on the front end, I said, what do you think the downside in your portfolio might be? They said, well, we told our broker we wanted to be conservative, so I'd say probably worst case 10 or 15%. So do you think it was a surprise to them when they found out that really it was 35 or 40? But here's the kicker. When we analyzed the yield, the amount of income being thrown off, it was 1.5%. So they were generating $15,000 a year in interest and dividends, but they were pulling out $35,000 a year to pay the bills. So they were taking a 3.5% withdrawal rate, but only 1.5% was being generated by interest and dividends. Now, this portfolio had gotten constructed in the last few years. So what they realized was, after running this report, that the only way they're going to continue to generate their income is if the market goes up every year. So we constructed a plan that's designed to throw off enough interest and dividends so that even if the markets fluctuate, we're able to generate the amount of income that they need. If this is something that you're asking of yourself, hey, how am I constructed? How much am I paying? What's my downside risk? What's my yield really look like in my portfolio? Give the 800 number a call. I'll set aside time on my calendar to do my retirement roadmap review with you, where we answer these questions, as well as what are the other things that we need to do to protect your retirement? How do we do the best tax planning, healthcare planning, legacy planning? These are all things that this review helps you do. Give the 800 number a call. I'll do this review for you at no cost, no obligation.
Once again, we hear a terrific story of how a retirement planning specialist can make such a big difference in the lives of those who are retired and nearing retirement. And again, folks, if you have any questions for your retirement planning specialist, just feel free, pick up the phone, call the number on the screen. You can talk to them. If you want, you can go in and visit with them, free of charge, no obligation. Don't miss out on that kind of opportunity. All right, let's go ahead and change gears a little bit, because this week I have a terrific IRA blow-up for you. This week's IRA blow-up comes to us courtesy of Ed Slott's IRA newsletter. Ed Slott, real CPA national expert on IRAs, and he brings us the story of how an unsuspecting IRA gets tapped in a bankruptcy proceeding. Now, generally speaking, and this, you may not know this, but generally speaking, when you file for bankruptcy, your IRA is what's called a protected asset. In other words, you don't lose your IRA to bankruptcy. However, in this case of James L. Daly, it turned out he lost his IRA to bankruptcy. So what happened here? In September 2012, the United States District Court for the Eastern District of Tennessee affirmed an earlier decision that a debtor's IRA was not protected in a bankruptcy proceeding. So what happened? Well, in this case, James Daly Jr. filed for bankruptcy in August of 2010. And at the time, he had an IRA with Merrill Lynch for about $62,000. Now, he had no other accounts at Merrill Lynch. This was the only account that he held with that firm. When he completed, now this cracks me up right here. This makes me just laugh. It says, when Daly completed the documents, in other words, when he filled out the paperwork to open up the account, he did not check the decline margin lending box in the IRA or the Merrill Lynch agreement. Now, by the way, when's the last time you think a person actually filled out their own paperwork for an account at an institution? I mean, no, the advisor fills out the paperwork. So did this guy really not check the box? No, the advisor didn't check the box. He just signed where he was told. I mean, who understands all these, you're talking pages and pages of documents. Who understands it anyway? But here's the problem with that. Technically, his IRA had the ability to do margin loans. Now, he never did any margin loans, but it had the ability to do a margin loan. And by having the ability to do a margin loan, what that means is that had he taken advantage of that, then the assets in the IRA would have been held as collateral on that loan, and you can't do that. That disqualifies an IRA. It makes it no longer an IRA. So what the bankruptcy court says is, even though you didn't do it, because you had the ability or the option of doing that, you've disqualified your IRA, thus it is part of your assets, and thus it is part of your, so we could take those assets for bankruptcy. The net effect, this guy had to cash out his IRA, pay all the tax on $62,000, and then give whatever was left over to the bankruptcy court. All because the Merrill Lynch guy didn't check a box. There you go. That's our IRA blow-up. Small mistake, big repercussions. And folks, that's our show for the week. I hope you enjoyed it. Remember, for you Bond fans, Skyfall.